Wanted to break down some economic data that we got on Friday. We got personal incomes, personal expenditures, and of course the inflation deflator PCE price index. This Friday coming up, although the market probably will be in hungover mood, we get non-farm payrolls. And I wanted to break down the economic data and show what this means for SPX, the stock market, or SPY stock, and how this could move the markets. Now, I've been pretty consistent with my analysis and what I think is probably likely to happen. Bond market is moving back upward with yields pushing back up to 4.5%. The reason inflation isn't necessarily dropping as fast as the market would hope. My initial take on everything on that is that the Federal Reserve will be lowering interest rates, but they will likely do so at a begrudgingly slow pace. And that is really going to frustrate the stock market. In the meantime, because inflation is not necessarily dropping as rapidly as the market would hope or the Federal Reserve would hope, I expect that the slowdown we're seeing because of the interest rates being as high as they have been and will continue to be so, we will see the stock market moving lower. And I've got charts kind of lining everything up so that you can keep a good idea as to what I'm looking at and why I believe what I'm believing for SPX, the stock market. Let's jump in and we'll look at some economic data. First up on the charts, we've got here personal income. This is where, for me, all analysis is driven. And the reason why is simply this. Government expenditures tend to be fairly flatline. Business expenditures will follow what supply and demand of individuals. The consumer is over 70% of our economy. So if the consumer is increasing their rate of growth of consumption on a year over year basis, this will drive businesses to respond. Or if we're seeing a decrease in consumption. Now, where does consumption, the numbers come from? Of course, income. How is personal income driven? First, you have a certain number of individuals on the payroll. If we get more and more individuals being added to the payrolls, you'll see personal incomes on a year over year basis increasing. Likewise, if individuals start moving up in the income ladders, getting raises, things like this will, on aggregate, push the income rate of growth higher and higher. Consumption follows suit. At the same time, if you consider where our economy is, we were sitting at 3.4% unemployment rate. That's way beyond full employment. So where does additional growth come from? What is the spurt? As you can see with this chart here, personal income, incomes on a year over year basis not pushing above median, which means consumption will not push really too far above median. We are seeing personal expenditures kind of hit right at that median level, but for me, I see further growth moving forward at a slower pace. Stock market just does not want to believe that. Fine. I'm still making my money. In the meantime, personal incomes versus personal expenditures, when you overlay these charts, I wanted to do this so that everybody could see that the correlation is pretty strong. There may be a lag or a delay based on certain factors. Of course, you can see some big sort of spikes higher and lower because of the COVID stimulus checks. Moving forward, personal expenditures versus core PCE. Expenditures drive price pressures. If expenditures are moderating and hitting a modest level, price pressures will do exactly the same thing. We are seeing continue to move lower in personal expenditures, kind of flatlining. This is driving core PCE price pressures lower. Great news, but it's not quite where we need to be. The past 2 months, if you look at core PCE inflation deflator month over month change, we got a real nice month over month change this month. But if you average the two from the previous month with this month, you can see that on average, it's not quite where we need to be. And this is the core. This isn't the headline. As it turns out, I'm looking at oil prices pushing up above $81 this morning. There's a lot of geopolitical concerns that are driving that. But with supply and demand, oil will probably be contained. As the economy kind of moderates somewhat, oil prices will be sort of contained because there will be increased supply. In the meantime, core PCE inflation deflator moving lower this month, but on average, not quite there. And this is what the bond market is really focusing on. I noticed that U.S. 10-year Treasury pushing 4.5%. I thought we were already done with that. But as you can see from those kinds of numbers, it's not quite there yet. All right. The blue is GDP. The orangish is, this is real personal income. So this is real GDP versus real personal incomes. And when we say real in the economics world, that just means inflation reduced, where you're seeing the actual based on inflation indicators from previous versus nominal. All right. As you can see, GDP, personal incomes kind of driving the same exact direction. Incomes will drive overall GDP. And if you remember the chart I just showed just a little earlier, personal income growth is below median, which means GDP we're likely to see below median numbers. And that's good news because we've been running on 12 cylinders. Way too hot, which is one of the reasons why inflation was as high as it has been. But the money supply was too liquid, and this drove housing inflation way high. And that's one of the variables that's really kind of still needs to be worked on overall. And unfortunately, I don't see anything really kind of fixing that anytime soon. So for this is the U.S. 10-year Treasury. Now I'll look at the 2-year and the 30, 20 or 30, but the 10 is a good indication right in between. So this is the one that I kind of look at the most. It's also the benchmark. Anybody savvy investors in the investment world are one of the first questions they're going to ask is, what's the 10-year? The 10-year yield is your benchmark. We're sitting just sub 4.5%, 4.47%. And to be honest with you, I thought we were done with these levels. We had moved lower, but the bond market, savviest individuals on planet Earth when it comes to trading, they're pretty good at figuring out what's next in the economy. And I've been saying this as well, and I'm going to continue to say this over and over again. We're going to see lower interest rates, but we will see the pace of the Federal Reserve dropping interest rates painfully slow. This will weigh on the economy. Incomes are already sub-median. Expenditures will follow suit. Because of that, the GDP is going to moderate sideways, but this isn't a recession. This just means we're not going to see 12 cylinders being fired all day long. Here's a bigger look at the U.S. 10-year Treasury yield. This goes all the way back many decades, actually. I don't see the 10 hitting 5 again this cycle. Exogenous events notwithstanding. We don't know if anything's going to happen again. I don't see that happening. So I do expect that we will see the Federal Reserve lowering interest rates at a slow pace all through 2025. Probably, I'm sort of 50-50 on whether or not they lower interest rates in 2024, but we're looking at November, December at the very, very earliest. But then probably not every single meeting, but maybe every other meeting. And this is really going to frustrate the stock market. I've been saying that I believe that all the work the Federal Reserve has been doing over the past 2.5 years, we will see this catch up September, October, November, December. That's when I see blood in the streets, actually, because the market's going to realize and really have to reckon with the fact that the economy is not going to be growing as rapidly. And because of that, stocks are not going to be able to be supported at these valuations. Now, there's an X factor, of course, and that's the AI stocks. AI stocks have been on fire. They're way overvalued, but then again, that's giving current information. Nvidia stock, of course, one of those stocks that, despite looking at it from a rational perspective, they come out every quarter saying, yeah, we blew out any expectations. Eventually, however, that's probably going to moderate. Other companies are going to catch up, but then the reality is that all this infrastructure buildup is going to start slowing down, and we're probably going to see stocks like Nvidia stock dropping. That's really kind of supporting the overall broader stock market more so than the depth of the Dow 30 or anything like that. That a lot of what we're seeing being driven is for AI stocks or a few stocks in general pushing the overall indexes higher. I think that's game over going into the fall. I've been saying that for well over a year now, that this is the time period we're getting close to. Summertime right now, not a lot going on. This particular economic data, non-farm payrolls hitting on Friday, that one is going to really kind of be a big yawn because everybody's going to be away. Here's another look at the S&P 500. This is the 4-hour bar chart going back several months, and I think we're probably topped out at this point. We're probably going to see a lot of sideways movement simply because this is summertime. Nonetheless, I wanted to kind of give you a preview of what I think might happen on Friday, what's going to happen, what we just saw last Friday, how that plays in, and how I'm encapsulating this into my market analysis going into the fall. I look that we see a lot more selling in the fall. And for now in the summertime, not a lot going on. That's the way summers have been traditionally. And this one, I think we're probably kind of staying right there. We'll see how that plays out. But I'm looking September, October, November, December. Things getting kind of crazy. Then the Federal Reserve starting to move. November, December, January, February, that kind of time frame. Nonetheless, that was for SPX. SPY stock, if you want, hit that like and follow button, and I'll keep you up to date on economic data. What would move SPX? We'll see you in the next video.